$64.10. That's where they took silver this morning. Friday, February 6th, 2026. Down 9.6% at the low before recovering to 71.75. And if you think that crash was organic, if you think that was natural market forces at work, I'm about to show you documentation that proves you're wrong. Mark here from GoFinance. Because what happened this week wasn't a market, it was a heist. And the evidence is sitting right there in the COMEX open interest data. Subscribe right now and drop a comment telling me if you've noticed the physical silver price in your area. Because I guarantee it's nowhere near $64, and that's the whole point. They crashed the paper price to 64 while the physical price barely moved. And the mechanism they used to do it? 400 million paper ounces dumped onto the market in less than 10 days. Not physical silver, paper, contracts, promises, IOUs that will never be delivered. Let me show you exactly how they did it, because the data doesn't lie. The price does, the headlines do, the analysts do. But the COMEX reports? Those tell the truth. And the truth is, they just pulled off the biggest paper dump in modern silver history to hide the fact that they're about to default on March delivery. Here's what you need to understand. Silver has crashed 43% from the January 29th peak of a 121.67 to this morning's low of 64.10. 43% in 8 days. That's the steepest collapse since 1980, since the Hunt brothers. Everyone knows this. The media has been screaming about it. The silver bubble bursts. Speculative mania ends. Reality reasserts itself. But here's what they're not telling you. While the paper price crashed 43%, open interest, the number of active futures contracts on COMEX, dropped by over 80,000 contracts. 80,000 contracts times 5,000 ounces per contract equals 400 million ounces of paper silver that just disappeared from the market. Not delivered, not rolled forward, not settled in metal, just gone, liquidated, dumped, erased. When prices crash, open interest typically increases because new shorts pile on and speculators try to catch the bottom. That's normal market behavior. But in silver, open interest collapsed while price collapsed. That means this wasn't short selling driving the price down. This was long liquidation. This was forced selling. This was margin calls. This was banks dumping massive paper positions to create the illusion of a price crash while the physical market held firm. Let me give you the specific data. In late January, when silver was above $100, total open interest across all COMEX silver contracts was over 245,000 contracts. As of February 5th, that number had dropped to approximately 160,000 contracts. 85,000 contracts gone. That's 425 million ounces of notional silver that vanished from the paper market in 10 days. But it gets worse. The March 2026 contract, which had 118,000 open contracts just 2 weeks ago, dropped to 101,040 contracts by early February. 17,000 contracts closed. But here's the critical part. Those contracts didn't close because people were selling. They closed because people were delivering. Let me explain what that means and why it terrifies the banks. Drop a comment right now. Tell me where you're watching from and whether you think COMEX can actually deliver in March. I read every single comment. Subscribe to GoFinance if you haven't already, because what I am about to show you won't be on CNBC. When you're long a silver futures contract and you want to close it, you have 3 options. Option 1, sell the contract and take your profit or loss in cash. Option 2, roll the contract forward to a later month, postponing delivery. Option 3, stand for delivery and demand physical metal. Normally, 98% of contracts close through options 1 or 2. Only 2% actually deliver. But in January 2026, something unprecedented happened. Contracts started rolling backward. Instead of rolling March contracts forward to May or July, traders were rolling March contracts backward to January and February to get immediate delivery. In one report alone, 850,000 ounces of March silver rolled backward to Jan-Feb contracts for immediate delivery. That's not normal. That's panic. That's, I don't trust this system and I want my metal now. So the exchange, the banks, the short sellers, they had a problem. Too many people demanding delivery. Too many people refusing to roll forward. Too many people saying, show me the metal. And they knew that if this continued into March, when the real delivery window opens, they wouldn't have enough metal to deliver. So what did they do? They crashed the price, violently, deliberately, using every tool at their disposal. Margin hikes on January 30th, coordinated selling on January 31st, another wave of selling on February 5th and 6th, and as the price crashed, leveraged longs got liquidated, stop losses triggered, margin calls forced selling, and 85,000 contracts, 425 million ounces of paper, disappeared from the market. But, and this is critical, the physical metal didn't come back. When those paper positions were liquidated, The physical silver that was supposedly backing them didn't magically appear in dealer inventories. Premiums didn't collapse. Availability didn't improve. Delivery times didn't shorten because the physical metal was never there. Those 425 million paper ounces were unbacked. They were naked. They were fraud. And now with those contracts liquidated, with retail traders wiped out, with weak hands shaken out, the banks can breathe for a moment. They reduced the delivery pressure. They bought themselves time. But the problem hasn't gone away. Because the people who didn't get liquidated, the people holding physical, they're not selling. Not at 64, not at 71, and definitely not at the paper price when the physical price is 20 to 30% higher. About 75% of you watching aren't subscribed. If this analysis is exposing what the banks don't want you to see, hit subscribe. Drop a comment and tell us, do you trust the paper price or the physical price? Now let me show you the mechanics of how they do this. Let me explain how 400 million paper ounces can crash the price of a metal that is in physical shortage. Because if you don't understand the mechanism, you won't understand why this is fraud. COMEX silver futures trade on leverage. Standard margin requirement is currently 15% after the January 30th hike. That means to control one contract, 5,000 ounces worth $450,000 at $90 per ounce, you only need to post 67,500. That's 6.7 to 1 leverage. Not as extreme as some markets, but enough that price swings hurt. Now imagine you're a trader who bought silver at $90 on February 4th. You posted 67,500 in margin. The next day, Friday, February 6th, silver opens and immediately starts dropping. 90 becomes 85, 85 becomes 80, 80 becomes 75, and then it accelerates. 70 becomes 65, and then 64.10. At 64.10, your position is down 25.90 per ounce times 5,000 ounces. That's 129,500 in losses, but you only had 67,500 in margin. You're underwater by 62,000. The broker isn't going to let that slide. Margin call, liquidate. Your position is sold at the market. You lose everything. And here's the beautiful part for the manipulators. When your position is force liquidated, it creates selling pressure. Your 5,000 ounces get dumped on the market, driving the price lower, which triggers the next margin call for the guy who bought at 85. His liquidation drives it lower still. Cascade, death spiral. 85,000 contracts liquidated. 425 million ounces of selling pressure, all on paper. None of it real metal. But the price discovery mechanism doesn't know that. The algos see selling. The headlines report lower prices. The chart shows a crash. And retail investors who don't understand the difference between paper and physical panic and sell their physical metal at depressed prices. That's how paper suppresses physical, by creating a fake price that people believe is real. Now here's where it gets criminal. The banks know this. They know leverage ratios. They know margin requirements. They know where stop losses are clustered. And they know that if they can push the price below key technical levels, they can trigger liquidation cascades. So what do? They coordinate. They wait for a moment of vulnerability, like a Friday morning when liquidity is thin, and they dump massive sell orders at market. No concern for price, no concern for slippage, just dump. Drive the price down fast, trigger stops. Force margin calls, and watch the cascade do the rest of the work for them. That's what happened this morning at market open. Huge selling pressure. Silver down 5% in the first hour, down 9.6% by mid-morning, hitting 64.10 before mysteriously recovering to 71.75. Mysterious? No. That's when the shorts covered. That's when the banks who sold at 85 and 90 bought back at 64 and 68. Profit locked in. Physical pressure reduced. Mission accomplished. But let me show you why this doesn't work long term. Because while they can manipulate the paper price, they can't manipulate the physical market. And the physical market is screaming shortage. India, MCX silver hit lower circuit this morning. Lower circuit means the exchange imposed a trading halt because price dropped so fast it violated daily limits. Silver on MCX dropped below 280,000 rupees per kilogram. That's rupees 2.8 lakh. The circuit breaker triggered because the market couldn't handle the volatility. And yet, despite hitting lower circuit, despite trading being halted, physical silver in India is still selling at premiums of 10 to 15% above spot. Why? Because there's no physical metal. Shanghai silver dropped 10% today. Not 9.6 like COMEX, not 16.5 like Thursday, 10%. Why the difference? Because Shanghai requires physical delivery. You can't play the same paper games on SHFE that you can on COMEX. If you sell a contract on Shanghai, you better have metal to back it. So when selling pressure hits, the price drops, but not to the insane levels we see on COMEX. Because physical buyers step in. There's a floor, a real floor made of actual silver. But on COMEX, no floor, just paper, just algorithms, just margin calls, just forced liquidation. The price can go as low as the liquidation cascade takes it, 64.10. Why not? $50? Sure. 40 if they can trigger enough stops, because there's no physical delivery requirement limiting the downside. The contract can be settled in cash. The short can just pay the long the difference and walk away. No metal changes hands, and that's the scam. COMEX is supposed to be a physical delivery market. That's the entire point of a commodity futures exchange. You trade paper contracts, but they're backed by physical delivery. If you want the metal, you can take delivery. That's what gives the paper price legitimacy. That's what connects the paper market to the physical market. But when 98% of contracts are settled in cash and only 2% are delivered, you don't have a physical delivery market anymore. You have a casino, a rigged casino where the house can print infinite chips and dump them on the table to crash the price whenever someone tries to cash out. And the evidence is in the open interest data. 425 million ounces of paper dumped in 10 days. That's 85% of global annual mine supply dumped in 10 days. If that was real silver, if those were real ounces being sold, where did they come from? Who mined 85% of annual production in 10 days and decided to dump it all at once? They didn't. It's not real. It's paper. And the fact that open interest collapsed while price collapsed proves it. Because in a real market, when prices crash, supply appears, sellers come out of the woodwork, open interest increases as new shorts pile on. But in silver, open interest dropped because it wasn't new selling. It was old longs being liquidated. It was margin calls. It was forced selling. It was banks shaking out everyone they could before March delivery. But here's the problem they can't solve. The physical silver they shook out didn't come back to the market. When retail traders got margin called and their contracts were liquidated, that didn't produce physical metal. The metal is still wherever it was, in vaults, in safe deposit boxes, in dealer inventories, charging premiums. The liquidation removed the paper claim on the metal, but it didn't produce the metal. And that's why this scam is failing. Because you can dump infinite paper, but you can't create physical silver. And when March delivery comes, in 21 days, the remaining longs are going to stand for delivery. The shorts are going to have to produce metal or default. And after liquidating 85,000 contracts, after dumping 425 million paper ounces, after crashing the price 43%, they still don't have enough metal. Let me show you how I know that. If the paper price is the real price, if 64 or 71 accurately reflects the supply-demand fundamentals of silver, then physical premiums should be low, 2 to 5%, normal. Because if metal was abundant, dealers would compete on price and premiums would compress. But that's not what's happening, not even close. Right now, Friday afternoon, February 6th, 2026, the COMEX spot price is $71.75. That's the official price, the benchmark, the price that headlines report. But if you actually want to buy silver, 1 ounce rounds or coins, here's what dealers are charging. Spot plus 12 to 14% premium. Some dealers are at spot plus 15. That means you're paying $82 for a 1 ounce coin when the spot price is $71.75. $10.25 premium on a $71 metal, 14%. That's not 2%. That's not 5%. That's 14%. And it's not coming down. On Wednesday, February 4th, premiums were at spot plus 12. On Thursday, spot plus 14. Today, spot plus 14 to 15. Premiums are rising as the paper price crashes. Explain that. Explain how a commodity crashes 43% from its peak, but premiums increase, unless the paper price is fake and it's not just US dealers. Let me show you what's happening globally. In India, even though MCX hit lower circuit at rupees 2.8 lakh, physical dealers in Delhi, Mumbai, Chennai are selling at rupees 3 lakh to 3.1 lakh. That's 7 to 10% premiums over the exchange price. The exchange crashed. Physical barely moved. In Shanghai, where COMEX closed yesterday at 76, physical silver was trading hands at 85 to 90. $10 to $15 premium, 20% over paper. And it's not arbitrage failure, it's shortage. Chinese buyers are paying 20% premiums because they can't get metal at COMEX prices. If they could, they would. But they can't. Because COMEX doesn't deliver to China. COMEX delivers to COMEX-approved vaults in New York or London. And when you factor in transport, insurance, and China's export controls choking supply, the real price in China is 85 to 90, not 76. In Europe, physical 1 kilogram bars are selling at spot plus 14%. Coins at spot plus 16 to 18%. UK dealers reporting 2 to 3 week delays. Germany, same story. Switzerland premiums even higher because Swiss refiners are backlogged. The entire global physical market is pricing silver 20 to 30% above the paper price. Now ask yourself, if COMEX is the benchmark, if COMEX is price discovery, why is the entire world ignoring COMEX prices and paying 20 to 30% more? Because they don't trust COMEX. Because they know COMEX is paper. because they know the real price, the price where physical metal actually trades hands, is not 71, it's 90, maybe higher. Do your own due diligence, understand the risks. This is not financial advice, but the data is the data. They dumped 400 million paper ounces this week. Open interest collapsed. Margins were hiked. Liquidation cascades were triggered. And in 21 days, March delivery opens. And the remaining 101,040 contracts, 505 million ounces, could stand for delivery. COMEX registered inventories, approximately 130 million ounces total. If just 25% stand, that's 126 million ounces. COMEX has 130 million total, but not all of that is deliverable. Some is encumbered, some is allocated, some is already promised. The pool of truly available unencumbered silver is probably 60 to 80 million ounces. So if 25% stands, the exchange is short 46 to 66 million ounces. They don't have it, they can't deliver, they default. Game over. The paper silver market says 77. The physical silver market says you can't buy it at 100. One of those numbers is lying. And in the history of commodity markets, when paper and physical diverge this far apart for this long, it's always paper that eventually tells the truth. Drop your silver price target for 2026 in the comments right now. I read every single comment, and I'll pin the best analysis. If you got value from this breakdown, share it with someone who needs to see it. This is Mark from GoFinance. They rigged the crash, but they can't rig the shortage. Stay sharp.